Have you ever wondered how some of the most successful investors make their decisions? Well, let me tell you about a book that's been a game changer for countless investors worldwide, The Intelligent Investor by Benjamin Graham. You might be surprised to learn that one of the book's most devoted disciples is none other than Warren Buffett himself. Yes, the legendary investor, often referred to as the Oracle of Omaha. Buffett attributes much of his success to the principles he learned from Graham's masterpiece. Now, before you roll your eyes and think, more get-rich-quick stuff, let me tell you, this book is different. It's not about the next hot stock pick. It's a timeless guide that helps you understand what investing is actually about. So are you ready to level up your investment game? Let's explore 5 key lessons from The Intelligent Investor that can help you become a smarter, more successful investor. Lesson 1. Know your investor type. Are you more of a laid-back, passive investor, or do you thrive on the thrill of the chase? The book identifies 2 types of investors: defensive and enterprising. Defensive investors prefer a more hands-off approach, focusing on steady, long-term gains. On the other hand, enterprising investors are willing to roll up their sleeves and put in the extra effort to beat the market. So, which one are you? Understanding your investor type can help you tailor your investment strategy to suit your personality and goals. Remember, there's no one-size-fits-all approach to investing. The important thing is to be honest with yourself about how much time and risk you're comfortable with. Lesson 2. Don't dance with Mr. Market. Imagine you have a friend named Mr. Market. He's a bit unpredictable. Some days he's super excited and offers to buy your share of the business for way more than it's worth. Other days, he's in a gloomy mood and wants you to sell your shares back to him at a ridiculously low price. The book uses the metaphor of Mr. Market to remind you that stock prices are often driven by emotion, not logic. The key takeaway: don't let Mr. Market call the shots for you. Focus on the actual value of your investment, and don't be afraid to take advantage of his wild mood swings. When he's down and offering bargains, it's your chance to buy low. And when he's overly optimistic and prices are high, think about selling. Always keep in mind that you're the one in charge, not the stock market. Lesson 3. Invest with a margin of safety. Let's face it, even the most experienced investors can't predict the future with perfect accuracy. Unexpected events can rock the market, and sometimes even the strongest companies stumble. That's why the concept of a margin of safety is your best friend. It's like wearing a helmet while riding a bike. It protects you in case of a tumble. Here's how it works. After carefully analyzing a company, you decide it's truly worth $100 a share. Instead of rushing to buy at that price, a wise investor aims lower, maybe $60 or $70. This gives you a built-in safety net. Even if the market takes a sudden downturn or your calculations weren't 100% precise, your investment has a much better chance of weathering the storm.
By the way, if you like this type of content, be sure to hit the like and subscribe button. Now, keep watching for the next 2 powerful lessons you need to know.
Lesson 4. Do your homework. Think of the stock market as a vast library filled with reports on thousands of companies. Some people wander in, grabbing flashy-looking stocks based on what others are buzzing about or the latest hot tip. But a smart investor knows that success demands some serious legwork. When assessing a company, be sure to analyze its financial statements to understand how profitable it truly is. Look for trends of consistent earnings growth, which is a sign of a healthy, thriving business. Consider the broader industry the company operates in, figuring out if it's likely to grow or face challenges in the future. Investing is not about jumping on the bandwagon or blindly following the crowd. It's about putting in the effort, conducting your own research, and making well-informed decisions. Lesson 5. Control your emotions, remain calm. Investing can be an emotional roller coaster. When the market rockets higher, it's easy to get caught up in the greed. When it crashes, panic might tempt you to sell everything. Reacting to every market twitch based on fear or excitement is a recipe for bad decisions. Stay calm and focus on your investment goals. The book reminds us that market fluctuations are normal. Instead of hitting the panic button, take a deep breath and remember why you invested in the first place. In the words of the wise Benjamin Graham, the investor's chief problem, and even his worst enemy, is likely to be himself. So don't let your emotions get the best of you. As long as you've done your homework and invested wisely, you'll weather the storm just fine. And that's it. 5 valuable lessons from the intelligent investor that can transform the way you approach the stock market, helping you make rational decisions and avoid costly emotional mistakes. Here's a question for you. Do you consider yourself more of a defensive or enterprising investor? Let me know in the comments below.
Now, you need to check out our animated video summary of The Millionaire Next Door, showing you how simple choices can lead to financial success.